So things are kind of getting back to converging as far as market and economy is concerned. So we thought of today, in place of a regular market guest, we thought of getting you a special discussion on the economy with the new face, Mr. Aurodeep. Aurodeep is the India Economist at Nomura. Aurodeep, thank you very much. Welcome to the show and to the channel as well. Talk to us about what kind of hypothesis are you building as far as the economy's direction is concerned. We've seen a lot of steps being announced by the RBI as well as the government, and you must have heard the commentary of the top corporates in India as well, how they are braving this environment. So how many quarters far out do you see this deceleration getting arrested first? Forget about growth.
So Ajay, I think it's really important to understand where we are coming from, right? And unfortunately, the Indian economy has gotten into the storm of COVID-19 in a really rickety ship. Now, before COVID-19, we were facing what I like to call a triple balance sheet crisis. You had a problem with balance sheets of corporates, of banks, and of shadow banks. And that itself was leading to a massive credit crunch within the system, a massive risk aversion within financial markets. In fact, it seems quite long back now, but it's only in March that you had a major private sector bank on the brink of default. So it's from this situation where an ailing patient was brought into a comatose state with the lockdown. Now, what happens during a COVID-19 kind of shock is that the seismic activities which we were seeing in the financial sector, among MSMEs, these are likely to get amplified with COVID-19 coming in. Now, what you're likely to see is two phases, right? You've had a phase of lockdown, which means that no one has been able to get out of their houses, and that has led to catastrophic impact on data, and that's expected, right? If you don't get people to go to factories, to go out on the streets, you're likely to get a sharp contraction in data. Now you're in a process where the lockdown is being relaxed, and we are seeing slowly an increase in mobility, around 30 percentage point odd increase in workplace mobility has happened. We've seen an uptick in a number of indicators, electricity, a little bit on the PMIs, a little bit in terms of just coal and steel. So some amount of production is now coming in the way. And typically, we've had a number of countries that are in fact gone through what India is going through now, which is exiting the lockdown. And in these particular countries, like China or Korea, you've had a certain amount of revenge buying, right? So consumers come back, they feel excited, they feel nice, and they're going to buy probably discretionary items. The problem is, and this is why I'm a little bearish on this, there are 5 reasons why I think that this might be impeded. One is just the thing that you've mentioned, which is that India hasn't managed to flatten the COVID curve during the lockdown. And once you're allowing the lockdown to be relaxed, you're going to have a situation where the risk of COVID cases rising would increase. So you're at a point where you're rising in terms not just of COVID cases, but also mobility. And this increases the chances of a possible second wave. 2 firms are going to face a really big problem as of now. They've essentially had to get lights on without having sales for the past couple of months, which means that they've got to get into a cost-cutting mode, which means they would either have to cut salaries or have to cut people. And you're in this unique situation where firms are struggling to get workers back, migrant workers back to their factories, but at the same point, they're not able to pick up the costs of the non-factory workers, the white-collar workers on their payroll. And this is likely to create a huge balance sheet crisis for corporates. Now, sure, the RBI has announced a moratorium, but look, moratorium is a little bit like hiding a dead body under a carpet. I mean, sure, you can't see it, but it's still there. this will spill on to consumers, right? So you've got a balance sheet crisis for households coming up. So households will have lesser income, will be more risk averse. If COVID cases are increasing, they're less likely to get into the contact sector services, which is a major proportion of the Indian economy. And then over and above this, you've got the external sector. Look, globally, this is a really tough time. So the export engine isn't going to work either. And finally, and I guess this is most important, is that our financial sector isn't really in a great shape, which means that getting finances is going to be a little tough. For all these reasons, I think we remain quite bearish on the economy. Q2 is likely to see a sharp contraction of our number is minus 15.2%. But then for the next 2 or 3 quarters, we are going to continue seeing negative.
Aurodeep, I understand your points. I understand your points. I saw your report, but I want to understand the model which you have prepared, the assumption which you are putting in the model, perhaps a worst case scenario as well. When do you see, or what does the model throw up in terms of output back to pre-COVID level? When is that happening? Is it happening mid of next year, end of next year? Where does what does the model actually talk about in terms of output back to pre-COVID levels?
So one is a big question of whether you'll reach back to pre-COVID levels, because you faced a productivity hit to the system. So the fact that a potential growth before COVID-19 and after COVID-19 might actually be quite difficult to match. In terms of when you go back, we are probably going to start seeing some improvement in the second half of 2020. But again, growth rates are likely to remain in negative territory. So we've got negative growth rates, consecutive quarters of negative growth rates running up to Q1 of 2021, that's Jan to March. Only beyond that, we would our current forecasts are building in some form of recovery. And again, I mean, it merits mention that if you're going to have a minus 15% cut in growth, say in Q2, obviously your Q2 2021 numbers are going to be elevated. So there's going to be a huge amount of base effect. But even a 7 or an 8% growth next year doesn't necessarily mean that you're out of the woods, because it's coming on the base of a really low growth as far as this year is concerned. But I think, so one is, how are you going to get out of the COVID part of it, right? And that would probably be by Q2 of next year. We should be in a better shape, assuming, of course, that your COVID cases stabilize. I think beyond that, you're likely to face the same problems that you faced before. So it's a little bit like your laptop is hung and you've shut it down and you've restarted it. And sure, it'll take some time to reach back to the same screen that you had. But you had problems with the laptop to begin with. So suppose your battery is heating up, or there's less memory. Those issues are still going to remain in 2021. And that's going to again start arresting growth. The same growth problems you had pre-COVID are likely to be going on in 2021, which will depress growth too.
Right. Aurodeep, leave us with thoughts on what are your FII clients when they speak to you regarding India. What are they most concerned about? What kind of questions are you probed most in terms of what are the factors which they want to know more about in terms of the readings, be it high frequency indicators, or is it government initiatives? What are you most asked about by our FII clients?
So there are 3 things, right? One is the question that you just asked, which is what's going to happen to growth? When is it going to come back to normal? How worried should we be about growth? The second aspect, which you often get asked, is on fiscal, right? There is this concern that the government's fiscal package remains modest compared to other economies. And I think, so the point I'd like to make there is that, yes, the government's cash component is quite low, 0.8% of GDP. The contingent liabilities is a little higher, which is credit guarantees of sorts, around 2.2% of GDP. But look, here's the thing. Even with 0.8% of GDP fiscal package, we're looking at a fiscal slip of around 7.7% of GDP. And that's because you're going to have catastrophic growth rates this year. Your tax collections are going to be really low. Your non-tax collections are going to be low. Your general expenditure it's going to be relatively high. So you're going to slip quite massively despite having a very small stimulus. You slipped last year despite there being no COVID-19 situation, right? So you're above 4% already in terms of fiscal deficit. So I think the question is, what's going to happen next on fiscal? And look, the fiscal package is designed for the survival phase. It's designed for helping vulnerable households, maybe vulnerable firms, MSMEs during this period. But once firms and households survive, you have a situation of normalcy in which you need a growth, a demand boost, and that this package doesn't do. So what we would possibly think is that this is a part of a wider fiscal package that would probably come in some time. And one of the things that investors are obviously worried about is the fact that the COVID-19 curve hasn't flattened. So if there's a second wave, what happens then? Are you likely to see quasi-lockdown situations continue going forward? And would that then mean that you need to give more policy support, both monetary as well as fiscal? So I think those are the key things that people are looking for. And the third thing, of course, is that there's a big chasm of haves and have-nots in the financial system, right? If you've got a strong balance sheet, in times of crisis, liquidity will flow to you. It won't be a problem. The problem is if you've got a weak balance sheet getting into the crisis, because at this point, you're going to find liquidity get away from you. So the challenge of getting liquidity to places that aren't getting enough, I think, is a key challenge for policymakers. So looking at corporate spreads, looking at what's happening with the NBFCs, how much their spreads are vis-a-vis corporates, vis-a-vis government securities, I think is another question. And finally, look, it's great to put on paper that the government has got a huge fiscal stimulus package, but how are you going to finance it? What's the metric going to be? Is the RBI going to step in? Is the market enough equipped on its own to absorb that amount of borrowing? I think that's the other worry which investors are looking at.
Right. All right, Aurodeep, thank you so much for your time today. I must say, that report was very scarily, the report which said that it's a dead body which you're just putting it under a carpet was a very scary way of putting things in perspective. But yes, you're right. Things are looking very grim right now indeed. And then there are no straight answers around right now. Thank you so much for your time. Great chatting. We'll see you again on the channel one of these days. That was Aurodeep Nandi, India economist at Nomura.